Welcome to Jared Invests, and today I'm giving you the only guide you'll need for getting your first credit card in 2026. The right way, without the traps. What if getting your first credit card at 18 is actually one of the worst financial decisions you can make, and the banks are counting on you not knowing that? Gen Z's average FICO score just hit a 5-year low, 676. That's 39 points below the national average of 715. Your generation is coming in with lower scores than your parents had at your age. And the crazy part is, most of you are doing everything you were told to do. You got the card, you're making payments, you're being responsible, and it's still not working. That's not bad luck, that's bad information. And that's exactly what we're fixing right now. By the end of this, you'll know which card to get, which cards to avoid, the exact number you need to hit every single month, and the 2 dates on your statement that most people mix up. And that mix-up alone costs Americans billions of dollars a year in unnecessary interest. Most first credit card guides are just card comparison lists, rankings dressed up as advice. Before we get to which card to get, I'm going to show you the one number that controls everything, and it's not your credit score, it's your utilization. Most people have never even heard the word before they apply for their first card. Banks are fine with that. Let's start with the actual mechanics of how credit scores work, because nobody sits you down and explains this before you sign your first application. Your FICO score, the score that lenders actually pull when you apply for a car loan, an apartment, or eventually a mortgage, is built from 5 factors. Payment history is the biggest one. That's 35% of your score. Whether you paid on time or didn't. Simple. But the second factor is just as powerful, and almost nobody manages it intentionally. That's credit utilization. 30% of your score. Together, those 2 factors control 65% of your entire credit score. 2 factors, 65%. The other 3, length of credit history at 15%, new credit inquiries at 10%, and credit mix at 10%, matter, but they move slowly. You can't speed up how long you've had an account. You can't undo a hard inquiry. But utilization? You can shift that in a single billing cycle. That's the number most people never touch. Here's where it gets specific. People with FICO scores above 800, the scores that unlock the best rates on everything. Those people average under 7% utilization. 7%, not 30%, not keep it under the limit. 7. Meanwhile, the U.S. average utilization in the third quarter of 2024 was 29%, right at the edge of the danger zone. Think about what that means practically. If your credit limit is $1,000, 30% utilization means you're carrying a $300 balance. Most people think that's fine. The people with 800-plus scores are carrying $70. That gap, $230, is pulling down millions of people's scores every single month. And if you're sitting at 50% utilization right now, dropping it to 10% can add between 20 and 50 points to your score within a single billing cycle. 1 month. No new accounts, no waiting. Just pay down the balance and report a lower number. Now here's the part that trips everyone up. Because this is where the bank's calendar and your brain's calendar do not match. When people think about paying their credit card, they think about the due date. That's the date on your statement that says payment due. Miss that and you get a late fee and a hit to your payment history. Pay by that date, most people think they're golden. But there are actually 2 separate dates you need to know. The due date and the statement closing date. They are not the same thing. Your statement closing date is the day your billing cycle ends. It's typically 20 to 25 days before your due date. And here's what nobody tells you. The balance that gets reported to the credit bureaus, the number that becomes your utilization, is whatever you owe on the statement closing date. Not the due date, the closing date. So you could carry a $900 balance all month, pay it down to $0 the day before the due date, and still have $900 reported as your utilization that cycle. Because by the time you paid it, the bureau had already received the number from your closing date. Most beginners don't know this. They pay on time, they never get a late fee, and their credit score barely moves, because the utilization being reported is high the whole time. Banks don't go out of their way to correct that misunderstanding. The fix is simple. Find your statement closing date, it's in your online account, and make sure your balance is low before that date, not before the due date, before the closing date. Now let's talk about the myth that costs people real money. 59% of all cardholders incorrectly believe that carrying a small balance improves their credit score. More than half. Wrong. Carrying a balance does exactly one thing. It generates interest charges for the bank. A $200 balance sitting on a card at 24% APR costs you about $48 a year in interest and does nothing positive for your score. Nothing. Pay the statement balance in full every single month before the due date. That's the move. And speaking of interest, let's put real numbers on this, because the math is what actually changes behavior. The average APR on new credit cards in 2026 is 23.75%. If you're applying for your first card with no credit history, expect 25 to 28%. That's not a penalty rate. That's just what they charge people who are new. Take $2,000 on a card at 22% APR. That's actually below average. And make only the minimum payment every month. Most minimums run around 1 to 2% of your balance. You'd pay roughly $800 in interest over 3+ years before that balance disappears. $800 on top of the $2,000 you already spent. At a below-average rate, Gen Z's average credit card balance right now is $3,493. For the first time ever, that number has passed the silent generation, Americans born before 1945, who averaged $3,445. Your generation is now carrying more average credit card debt than people who lived through the Great Depression. That's not a shot. That's just the data. And it matters, because at 25% APR on $3,493 with minimum-only payments, you're looking at over $1,500 in pure interest charges stretched across years. 58% of Gen Z cardholders pay only the minimum on at least one card, nearly double the 41% rate across all age groups. Most of them are not doing it because they're irresponsible. They're doing it because nobody ever ran the math for them before they signed up. Now you've seen it. So which card should you actually get? There's no universal right answer, but there are clear best options depending on your situation. Let's walk through them by scenario. If you have zero credit history and want to build it fast with actual rewards, the Discover It Secured card is the strongest first card in 2026. No annual fee. The minimum deposit is $200, which becomes your credit limit. The APR is 26.49%, which is in line with beginner rates. But the real feature is cashback match. At the end of your first year, Discover doubles every dollar of cashback you earned. Whatever rewards you got in year one, you get that same amount again as a bonus. No other secured card does that at $0 annual fee. After 7 months of on-time payments, Discover reviews your account for an upgrade to unsecured, and they return your deposit. You get your $200 back. If you want to start unsecured, no deposit required, and you already have a Chase checking account, the Chase Freedom Rise is worth a look. No annual fee. 1.5% cashback on every purchase. No categories to track. The APR sits at 25.24%, and because it's unsecured, no deposit ties up your cash. The catch? Chase looks more favorably on applicants who have a Chase checking account with at least $250 in it before they apply. Already banking with Chase, low friction. Not banking there yet, it adds a step. If you're a student, currently enrolled in college, Capital One Saver student deserves a look. No annual fee, a $50 welcome bonus after your first purchase, and above-average cashback on dining and entertainment, which is where most students actually spend money. Capital One's approval odds on their student cards generally beat non-student cards, so if you've been denied elsewhere, that's a reason to start here. If you have no deposit money at all and are not a student, the Capital One Platinum Secured is still a real option. The minimum deposit can be as low as $49 depending on your application. They sometimes approve a reduced amount. No annual fee. The APR is 28.99%, which is high, so treat it strictly as a credit-building tool. Run one small recurring charge through it each month. Pay it off in full before the closing date. Do nothing else with it for 6 months. Then request a credit limit increase. That one move alone can drop your utilization. Here's the decision tree in plain terms. No credit history, want rewards, Discover It Secured. No credit history, no deposit, have Chase checking, Chase Freedom Rise. Currently a student, Capital One Saver student. No deposit available, not a student. Capital One Platinum secured. One more thing on the card question, and most guides skip this entirely. If a parent or family member has a credit card with a long clean history and a low balance, ask them to add you as an authorized user. You don't even need to use the card. The account shows up on your credit report immediately. The age of the account, the payment history, the utilization, all of it starts working in your favor right away, sometimes within a few weeks. 34% of Gen Z adults are already on a family card this way. It's the fastest zero-cost way to get a head start before you ever apply for your own card. If that option exists for you, it should be your first move, not an afterthought. The credit building timeline works like this. With no credit history at all, FICO needs 3 to 6 months before it can even calculate a score. That's just a minimum data threshold, nothing you can shortcut. From 0 to a 700-plus score with consistent on-time payments and managed utilization, you're looking at about 12 months. 1 year of disciplined behavior. If you're an authorized user on an established account, you can skip the first 6 months entirely and start with a real score on day 1. 12 months feels long until you do the math. A 700-plus score is the difference between a 7% car loan rate and a 12% rate, which on a $25,000 car means over $3,500 in extra interest across 5 years. Or the difference between getting approved for an apartment in a competitive building and getting turned away. Or locking in a mortgage rate that saves you $40,000 over 30 years versus one that costs you that money. The 12 months of discipline now is the cheapest investment you'll ever make. Let's bring it home with 3 rules. Just 3. Remember nothing else from this video, and you can still hit 750 faster than almost anyone around you. 1. Pay the statement balance in full before the due date, not the minimum, not a partial payment, the full statement balance, every month. No interest charges. Payment history stays at 100%. 2. Keep your utilization under 10% at the statement closing date, not 30%. 10. Find out when your statement closes and make sure your balance sits under 10% of your limit by that date. On a $1,000 limit, that means keeping your balance under $100 before the cycle closes. Need to spend more in a given month? Make a mid-cycle payment to pull the balance down before closing. 3. Set up autopay, but set it to the statement balance, not the minimum. Almost every card lets you choose what autopay covers. The default option most banks push is the minimum payment. Change it. Set it to the full statement balance. That one setting change means you can never accidentally pay only the minimum, never stack up interest, and never miss a payment. Set it once and it runs itself. Most people will spend their entire 20s with a mediocre credit score wondering why they keep getting bad rates. They'll carry balances thinking it helps. They'll pay by the due date instead of the closing date. They'll never look at the actual utilization number. All of that is fixable. None of it is complicated. You just need to know the rules of the game before you're already losing it. So here's what I want to know. Drop it in the comments. Are you building credit from scratch right now? Or did you get a head start as an authorized user on someone's card? And if you've already walked into one of these traps, the balance myth, the wrong date, the minimum payment spiral, which one was it? Because someone scrolling through these comments needs to see your answer. If this cleared up something nobody ever explained to you, send it to one person who just turned 18 or just started thinking about their first card. Hit the like button too. It genuinely helps this video reach people who need it before they sign an application they don't fully understand. Subscribe if you enjoyed the video.